Are you tired of living paycheck to paycheck and feeling financially trapped? I know that feeling. My finances felt like a leaky faucet, constantly draining away, while I compared myself to friends who seemed secure. Then I learned about delayed gratification and everything changed. This one principle helped me break the cycle of financial stress that had controlled my life. Today I'm breaking down the 10 crucial money lessons that turned my finances around completely. Want to know the secret? Most successful investors follow the boring, passive strategy I'm about to show you, not the complicated systems financial gurus push. What if the biggest money deception isn't some complicated investment scheme, but something as simple as the coffee you grabbed this morning? It seems unimportant, right? Just a few bucks. But it's a tiny piece of a much larger pattern that keeps people financially stuck. You work hard, maybe even get raises, but you still feel like you're barely getting by. It's confusing. Then you scroll through Instagram or TikTok, you see friends, or maybe just people you follow, showing off new cars, amazing vacations, designer clothes. They look like they have it all figured out. They seem successful and happy. This constant stream creates pressure. It plants a seed in your mind. Maybe you start thinking, I work just as hard, I deserve nice things too. You begin to stretch your budget just a little. Perhaps you see that shiny new gadget and think, the monthly payment isn't too bad. You sign up for a payment plan. You buy that slightly nicer car than you really need. You're trying to project an image, to keep up appearances. This is the classic $30,000 millionaire trap. Looking wealthy on the outside, maybe earning a decent salary, but secretly drowning in payments and stress. It's all fueled by comparing your everyday reality to someone else's carefully selected highlight reel. You're comparing your behind-the-scenes footage to their movie trailer. This brings us to the first big lie. Keeping up with the Joneses is normal and expected. It's not. Truly wealthy individuals, the ones building lasting security, often live surprisingly below their means. They aren't constantly upgrading their cars or buying the latest trends. They prioritize saving and investing over impressing neighbors. The truth is, focusing intensely on your own financial path, your own goals, is where real progress happens. Forget the Joneses, they're probably stressed about their own bills. Then there's lie number 2. Small daily purchases don't really impact my overall finances. That morning coffee, the lunch out, the subscription you forgot about, they seem insignificant alone. But add them up. $5 a day on coffee is over $1,800 a year. $10 a day on lunch is over $3,600. When you actually start tracking your expenses, even just for a month, you get a shocking look at where your money really goes. It's not about depriving yourself of everything, it's about awareness. Knowing where the leaks are is the first step to plugging them. That awareness gives you control back. And this leads directly to lie number 3. If I can comfortably afford the monthly payment, I can afford the item. This is one of the sneakiest traps. Financing makes expensive things feel accessible. That $1,000 phone becomes $40 a month. That $30,000 car becomes $500 a month. But fitting a payment into your budget doesn't mean you can truly afford the item without financial strain. A better rule? Real affordability means being able to buy the item twice in cash without wrecking your savings or causing anxiety. This forces you to practice delayed gratification, resisting the small, immediate urge to buy now for the much larger reward of financial stability and freedom later. It's about choosing future you over instant you. Falling for these lies, constant comparison, justifying small leaks, and confusing monthly payments with true affordability keeps you on a treadmill. You're working harder, earning more, but going nowhere financially because the spending keeps pace or even outpaces your income. You never build a safety net or get ahead. Social media is designed to make you feel inadequate by constantly showing you curated, perfect-looking snapshots. It rarely shows the credit card debt, the car loan stress, or the empty savings account behind the scenes. Breaking free starts right here. Ignore the external noise. Focus entirely on your numbers, your progress, your goals, not their filtered vacation photos. Understanding the spending trap is crucial. But okay, maybe you've already bought some of these things. That big screen TV, the new furniture. Are those items helping you build wealth, or are they actually anchors weighing you down? You bought that shiny new car, or maybe it was that super comfortable couch. Feels pretty good owning it, doesn't it? That moment of satisfaction is real. But hold on, could these things you think of as assets actually be pulling money out of your pocket every single day, making you poorer? We hear people talk about good debt and bad debt. Maybe student loans that lead to a higher paying job could be good debt. Taking out a loan to start a business that grows could be good debt. But what about borrowing money? Going into debt for things that start losing value almost the second you get them home. Think about a brand new car. The moment you drive it off the lot, its value drops. That's depreciation. If you financed it, you're paying interest monthly on something worth less and less. This applies to big screen TVs, smartphones, furniture, even trendy clothes bought on credit you don't pay off immediately. Financing these items, even with manageable payments, means you pay far more than the original price due to interest, while the item's value plummets. It silently drains your potential wealth. This leads to lie number 4. Financing depreciating items is okay if the payment fits my budget. This ignores the long-term cost and the reality of paying extra for a declining asset. Let's clarify the difference. Good debt, potentially, loans for assets that could increase your income or net worth, e.g., education, business investment, maybe real estate. Bad debt, loans for assets that rapidly lose value, e.g., cars, electronics, furniture bought on credit. Avoiding bad debt is crucial for building wealth. It's one of the biggest drains to plug. So, avoiding debt on depreciating items plugs a major financial leak. But stopping leaks isn't enough. You need to actively build savings. Many believe slow, steady saving is sufficient, relying on compound interest. This brings us to lie number 5. Slow and steady savings always wins the race. While consistency matters, getting to your first $100,000 saved depends more on how much you save aggressively than investment returns early on. Your savings contributions have the biggest initial impact. For instance, saving $13,000 annually for 6 years at a 7.5% return gets you around $101,000. Crucially, your contributions $78,000 make up about 77% of that total. The amount saved did most of the work. Even a higher 10% return over 7 years, $104,000 total, still sees savings contribute about 67%. The initial climb relies heavily on your discipline to save a significant income chunk. Simultaneously, don't get paralyzed thinking you need complex tracking. That leads to lie number 6. I need complicated financial tracking to get ahead. Simplify by focusing on 3 numbers. 1. Expenses. Know where your money goes monthly. Track it. 2. And savings rate. What percentage of income are you saving? Aim for 10% plus, higher if possible, especially for that $100,000 goal. 3. Net worth. What you own minus what you owe. Track this over time for true progress. Focusing here simplifies things and keeps you on target. Understanding this double trap is key. Financing assets that lose value means paying interest on something becoming worthless, stealing from your future savings potential. Reaching that crucial first $100,000 milestone relies far more on intense saving discipline in the early years than on finding spectacular investments. Build that savings muscle first. Okay, you've worked on stopping the spending leaks, and you get the importance of aggressive saving and avoiding bad debt. Now, how do you actually make your money grow? How do you invest without falling for the common investing lies that trip so many people up? Does just thinking about investing make your head spin? You hear about complicated charts, trend lines, endless stock options, and online gurus pushing some secret formula. It feels like you need a finance degree just to get started. But what if the real secret to successful investing isn't exciting or complex at all? What if it's actually kind of boring? Imagine being glued to financial news, heart pounding with every market dip, constantly stressed about picking the next hot stock or timing the perfect moment to buy or sell. It sounds exhausting, right? Many believe this constant activity is necessary, chasing short-term gains and trying to outsmart the market. But here's the reality. Trying to predict market movements is incredibly difficult, even for Wall Street experts. Most forecasts are wrong, and this constant guessing often leads to worse results due to mistakes and fees, not better ones. It's a high-stress, low-reward game for most people. Instead of that frantic chase, consider a proven strategy that's surprisingly simple and passive. It involves buying broad market index funds. A common example is an S&P 500 ETF, which gives you ownership in 500 large US companies all at once. You buy these funds and then you hold on to them for the long term. Think of it like planting a tree. You put it in the ground, water it occasionally, and let it grow steadily over many years to provide shade. You don't dig it up every day to check the roots. This buy and hold approach prioritizes consistency and patience over trying to be a market wizard. This simpler approach also tackles diversification effectively. You don't necessarily need dozens of different investments, which can add complexity and fees. Often just 1 to 3 well-chosen, broadly diversified ETFs are sufficient. Simplicity usually wins. Consider this proof. S&P Global Research shows that over 15 years, simply buying and holding an S&P 500 ETF would have beaten about 92% of professional fund managers. Why? Because this boring, simple strategy avoids the high fees and guesswork inherent in active trading, letting the market's long-term growth work for you. When you invest for the long haul, think 20 years or more, history shows the market's ups and downs tend to smooth out. Staying invested through the bumps is far more crucial than reacting to scary headlines or trying to time your moves based on predictions. Remember, what works for a friend or an online personality might not suit your unique financial situation, risk tolerance, or goals. Always filter advice through your own circumstances. So what's the real mistake? It's often getting caught up in complexity, trading too often, paying high fees for products you don't understand, or panic selling during downturns. Tracking your net worth helps reinforce the power of sticking with a simple, long-term, boring approach. Even Warren Buffett champions this, focusing on owning solid assets for the long haul. His success underscores the value of discipline and long-term thinking over market hype. Forget complexity, embrace simple, consistent actions. The biggest money lies aren't tricky Wall Street schemes. They're the everyday beliefs holding you back, like spending because others do, financing depreciating assets, or feeling like saving is impossible. Real progress comes from consistently applying simple truths, not complex strategies. Ditch the lies, stick to the basics daily. So here's your challenge. Identify one lie holding you back. What one small step will you take this very week to fight it? Share your commitment below. Remember, you absolutely can change your financial future. It truly begins with making these fundamental shifts starting today.